Hey guys, what's up? I'm Erin and welcome back to the channel. 6% on cash is finally here and I'm excited. Are you excited? This is big news. Why? Because interest rates haven't been this high in 16 years. 16 years ago, I was a freshly minted college grad, ready to take on the world. And back then, I didn't care about cash like I do today. Today, I place a greater emphasis on having a solid emergency fund. And when it comes to my cash, I want to earn a decent interest rate. Just like so many of those other retro trends coming back, so too have these higher interest rates circled back around. Interest rates hit brand new highs as a result of last week's Federal Reserve meeting, where they once again raised interest rates. This time they were raised by 0.25 percentage points. This marks the 10th consecutive rate increase in just 14 months. The benchmark rate now sits between 5 and 5.25%, up from a whopping 0% last March. And all of these increases are in response to the high inflation we've been experiencing, which is finally working its way down. Latest measures peg inflation at 5%. And while that's certainly great progress from this time last year when inflation was sitting around 9%, 5% is still higher than what the Fed's goal is, which is 2%. This rate hike is notable because the Fed has hinted that this is going to be their last rate hike for quite some time. Federal Reserve Chairman Jerome Powell said, "We're no longer saying that we anticipate additional interest rate increases." And that's a significant change in tone from the past year and a half when rate hikes were all we had on the horizon. And these higher interest rates coupled with high inflation are making just about everything more expensive. It's more expensive to buy a home, to buy a car, and really take on just about any sort of debt. And just about every consumer is reporting feeling the effects of inflation. And the intent of keeping these interest rates high is that we can cool down the demand for a lot of these products
and slow down demand.
And the more expensive it is to borrow or to take on debt, the less incentive there is to do it. And when it comes to debt, I always say that it's important to be careful. You only want to take on debt when absolutely necessary. For example, a mortgage would be a great example. A lot of people need a mortgage when buying a home. But still, at that point, you want to make sure that you're keeping your debt burden in check and that you're living within your means. And this becomes increasingly important as these interest rates tick upwards. As far as those bad types of debt, it's just best to stay away from them altogether, regardless of interest rate. But there's a silver lining. If you aren't looking to take on any debt or to borrow money, you can take advantage of these higher interest rates and you can earn a decent return on your cash. I've made a few videos on this subject, and I will continue to do so anytime there are rate changes because my goal is to ensure that everyone is earning a decent return on their liquid cash, their emergency savings, and their short-term cash reserves. Because believe it or not, while you can easily find accounts paying 4, 5, or 6% on cash, some people aren't moving their money from those traditional savings accounts at the big banks. And those big banks out there stubbornly haven't raised their rates. And quite simply, they don't have to. Many still have interest rates that are less than 1%. So why reward them with your business if they're not willing to give you a decent return on your money? The biggest argument people make is it's a hassle to switch. And maybe, but not really, because most transfers can be done with just a few clicks and setting up a wireless transfer. All in all, the whole process could take about 10 minutes, and I'd say that's 10 minutes well spent. Here's why. Let's say you have $20,000 in short-term cash reserves at the ready. If you leave that sitting in a big bank traditional savings account currently paying 0.01% interest, that will get you a whopping $2 over the course of the year. However, if you move that $20,000 into an account netting you a 6% rate of return, that will get you $1,200 over the course of the year. That return is 600 times larger. It seems like a no-brainer to switch. We all likely have some level of emergency savings or short-term cash reserves. Why not earn some kind of decent return on this cash? After all, if you leave it in an account that's earning next to nothing in interest, not only are you deliberately foregoing a better interest that could be achieved elsewhere, but you're also losing purchasing power on your money due to inflation. And the goal is to preserve the purchasing purchasing power of your cash. Now, I fully acknowledge that there are absolutely times when it's a hassle to switch accounts. For instance, if I was in an account that was paying 5.25% and then I found a new account that was paying 5.75%, I probably wouldn't bother switching. I don't think it's a good idea to switch your money every single week chasing the latest and greatest next highest interest rate. But I do think when you notice that there are accounts that are paying significantly higher rates, then it's time to switch. You just want to make sure that you're getting a competitive market rate when it comes to your cash and when it comes to those interest rates. The very best places you can park your cash are going to be high yield savings accounts, money market funds, CDs, and T-bills. Now, any and all of these accounts can be a great place to park your cash. They each have their pros and cons. It really just depends what you're looking for in an account. High yield savings accounts are great for keeping your money easily accessible. You can generally get at these funds whenever you want without any hassle. They offer competitive market rates, but being that you can get at this money whenever you want with no stipulations, you're generally going to have an interest rate that's a little bit less than, say, what you would find on a CD. And the caveat here is that these interest rates are not guaranteed. They are pegged to the marketplace interest rate. So the interest rate you're getting today is not necessarily what you're going to get next month or 2 or 3 or 4 months from now. That interest rate will change as the market rate changes. And most of the time you're going to find high yield savings accounts with online banking institutions. These days you can easily find high yield savings accounts paying at least 4 or 4.5%. A money market fund can be thought of as a high yield savings account, but rather than being held with a bank, it's held with a brokerage house. Think of Vanguard or Fidelity. They offer competitive market rates, and perhaps there's an added convenience if you already have your investments here or you already have your emergency fund here. It's one less institution that you would have to keep track of. The money here is readily accessible, but you do want to read the fine print on these accounts because many of them do have transaction limits to the number of transactions you can make within a given statement period. So just know what that limit is if you are planning on keeping your emergency savings here. Also, they can have high minimum limits. So again, just read that fine print. Another thing to note is that this interest rate is not guaranteed. It's not locked in over time. It's pegged to that market rate, so expect that that rate will fluctuate just like it would in a high yield savings account. Currently, the Vanguard Money Market Fund is paying about 4.8%. CDs are another great option for your short-term cash reserves, and CDs will tend to have higher interest rates than, say, a high yield savings account, and they generally have a guaranteed interest rate for the entire term length of that CD. Now, because these CDs do offer a more alluring interest rate, they tend to come with more restrictions on your money. First and foremost, your money tends to be locked up for the entire term length of that CD. Now, to say it's locked up might be a bit of a stretch because generally most CDs will allow you to cash out early if you do need this money, but just keep in mind that there's generally a penalty in the form of lost interest. Currently, you can find CDs paying in the 5% range. T-bills are another great option when it comes to your short-term cash reserves. And currently, they're offering the highest available interest rates in the marketplace. And this interest rate is guaranteed. And they're offered in a wide variety of term lengths, anywhere from 4 weeks all the way up to 52 weeks. And as an added bonus, they're not subject to state taxes or local taxes, just federal taxes. So they're tax advantaged. There are a wide variety of ways you can buy T-bills. You can buy them through the Treasury's own website, treasurydirect.gov, or simply through a brokerage house. Think Vanguard or Fidelity. And depending on how you buy them, your money may be locked up for the entire term length of that T-bill, or maybe you can sell it early. Just depends on how you buy them. Current T-bill offerings have been just shy of 6%. And if you're at all curious about T-bills, which happen to be my favorite place to keep cash right now, I do have a video that covers everything you could possibly want to know about them, and I will link it down below. When you're deciding where to put your cash, think about what your needs are. When do you need this money? Do you need it next week, next month, or maybe not until next year? You want to be able to access this money whenever you need it. And remember, when it comes to all things finance, read the fine print. Not all accounts are created equal, so you want to know and understand where you're putting your money. For instance, some CDs have a callable feature. So if interest rates drop in the marketplace, the bank has the right to call your CD or to cash you out. So you might have thought you've locked in a great rate for, say, 12 months, and then poof, this option doesn't even exist anymore. You just get your money back. Or there's sneaky marketing tactics, like high-yield savings accounts that advertise a really high interest rate. It's really alluring until you dig into it and then find that that really high rate only applies to the first $500 or the first $1,000 in the account. The remaining balance just gets a lesser paying interest rate. So you just want to make sure to read the fine print. We can expect that these interest rates are going to be the typical available interest rates for the near-term foreseeable future. Yes, the Fed does have other meetings scheduled this year. Next one is slated for mid-June. But based on the chairman's thoughts, we can likely predict that there will not be another rate hike at the next meeting. Mr. Powell said the bank was getting close or maybe even there when it came to pausing its rate hike campaign, but was prepared to do more if warranted, adding, "will be driven by incoming data." The Fed will continue to be cautious as the economy is still in a precarious situation. The goal is to bring down inflation by utilizing these higher interest rates, all while avoiding a recession. And the Fed chair still remains optimistic, saying, "I continue to think it's possible with regards to avoiding a recession." Though there absolutely have been rough economic patches, hiring has remained strong, unemployment has remained low, and the market has performed better this year. I know inflation is causing a lot of people a lot of pain right now. A lot of people have had to adjust their spending habits. But getting inflation under control, that's still the primary goal of the Fed. But the silver lining to come out of this is that on a personal level, you can take advantage of these higher interest accounts on your cash. Don't miss that opportunity. And once inflation is under control, it's very reasonable to expect that these interest rates will come back down. And then the high interest rates of today will just be a thing of the past. But always keep in mind that these cash accounts are not a substitute for long-term investing. So make sure you're still investing for your future. Where are you keeping your cash these days? Leave your thoughts in a comment down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye.